The space today is $2 trillion. I think it's going to $100 trillion. That's just the extrapolation of market cap or the log regression channel of the price of Bitcoin. You can kind of back it out in a number of different ways. And maybe I'm an idiot, wrong by 50%. It goes to 50 trillion by 2032, 2034, something like that. And so the job, therefore, is to ride that trend. It's not, because one thing that people don't understand is it will not be a $50 trillion Bitcoin world. Bitcoin might be 10 trillion. Well, there's going to be 40 or 90 trillion of value created somewhere else. And that's what hedge funds can do.
In a thought-provoking conversation, Raoul and Tushar Jain delve into the future of cryptocurrency, envisioning a $100 trillion industry by 2032. They explore beyond well-known assets like Bitcoin and Ethereum, shedding light on the untapped potential of low-float tokens and the transformative power of blockchain in reshaping economic design and value creation. During the interview, Tushar Jain emphasizes blockchain's potential for coordination, token economic design, and value capture, particularly focusing on productive assets like DeFi and Solana. Raoul predicts that the cryptocurrency market will grow from $2 trillion to $100 trillion by 2032. He stresses the importance of looking beyond Bitcoin, Ethereum, and Solana to seize this opportunity, noting that hedge funds are adept at uncovering alpha and managing risk. Pal highlights that hedge funds, with their capital at stake, must prioritize risk-adjusted returns. He also touches on the behavioral economics of token value and network effects, suggesting that these dynamics are still not fully understood. Pal identifies low-float tokens as a significant opportunity due to their known supply and lower pricing, offering an asymmetric risk-reward profile. He foresees enormous growth, with the potential for $50 trillion or more in value creation beyond Bitcoin.
Stop. You don't have time. Don't miss out this 2025 bull run. Educate yourself first ahead of the crowd. We have created the ultimate step-by-step crypto cheat guide that will guide you this bull run. Unlock the secrets of crypto and make smarter investments today. Now by clicking on the link below to get your exclusive copy just under $10.
I also built a business around this called Exponential Age Asset Management, is because I think hedge funds offer the great opportunity to capture the alpha in markets. You see, the crypto markets are going to go from, I think, $2 trillion where they are today to something like $100 trillion by maybe 2032. That's an enormous rise, and we won't capture it all by just focusing on Bitcoin, Solana, and Ethereum. We need to be able to move further out the risk curve, but that's bloody hard. It's not something I can do. This is what hedge funds are really good at. They do this. They spend all of their time looking for alpha, looking for opportunities. So I find speaking to hedge funds super rewarding, because these guys have capital on the line. They not only have their own personal capital, they also have investor capital. So their job is to focus on the best opportunities in a risk-adjusted return basis. I too was class of 2013 with Bitcoin. One of the things that I saw in it immediately was the game changer in terms of both capital formation and kind of aggregation of interest of people is the behavioral economics side of this thing. Because, you know, you bring people into a network and the token value goes up because of Metcalfe's law, increases the value of the network. And that allows you to bootstrap businesses really fast. And I still think that hasn't been fully yet understood by people in what that means. Yes, we see some perverse incentives now, you know, airdrops or you know, sort of ways of farming it. But I think the ICO thing was the start of something much bigger. I've also been thinking through these low float tokens. And one thing that I think firstly is now the market discounts them. So therefore you get a good shot in the liquid markets to make a decision, because the decision I think you've got to make is the supply is known. So that's off the table. Yeah, in typical markets, unknown supply, unknown demand, that's complicated. Known demand, not known supply, you can model something, and the reverse side. So I look at these and like, I know what the supply is going to be because we've now got the unlocks. The tokens have been discounted because low supply. And then what you know is, well, if demand does come, the beta of a low float is gigantic. And I think it's going to crush everybody's understanding of what low float means in this bull market. And they'll all be wrong. And they'll be wrong because limited float, but good demand, because some of these are really great projects, will create really asymmetric risk rewards. I don't think anybody understands this because they think future token unlocks always mean the price under pressure. Yeah, in a bear market, they'll probably go down more than others. But in a bull market phase with a very small float, I think this is very interesting. The space today is $2 trillion. I think it's going to $100 trillion. That's just the extrapolation of market cap or the log regression channel of the price of Bitcoin. You can kind of back it out in a number of different ways. And maybe I'm an idiot wrong by 50%. It goes to 50 trillion by 2032, 2034, something like that. And so the job, therefore, is to ride that trend. It's not, because one thing that people don't understand is it will not be a $50 trillion Bitcoin world. Bitcoin might be 10 trillion. Well, there's going to be 40 or 90 trillion of value created somewhere else. And that's what hedge funds can do, because that's a hard job. You need to be super focused to think, where is the really big value accrual? Like you did with Solana. Classic example is you see something really early stage and the value accrual has been vast from that and it's not over. And that's what I think the bigger opportunity. If people zoom out, stop worrying about the cycles as much and just think, how do I capture that trend? Because I think that is the largest, fastest accumulation of wealth in all human history if that plays out.
Tushar Jain highlighted the groundbreaking nature of Ethereum's launch in 2016, showcasing blockchain's ability to facilitate cooperation and product development. He pointed out that blockchain serves as a coordination technology, enabling individuals to collaborate and align incentives to create economically significant products. Jain is particularly interested in protocols that support this, such as DeFi and stablecoins, which rely on blockchain to be viable. He also emphasized the importance of token economic design and value capture, noting that his team has conducted extensive research in these areas. Jain explored the differences between the venture capital and liquid crypto markets, focusing on aspects like token lockups and float. He stressed the significance of productive assets like Solana and Helium, which generate goods, as opposed to purely financial assets like Bitcoin. Let's return to the interview and watch more clips to gain further insights from Tushar Jain.
When I saw crypto, I got really excited. I first heard about Bitcoin in 2013, and I bought a couple, literally just two. I wish I had bought more. Everyone wishes they had bought more back then. But Bitcoin wasn't for me at the time because it was all about hard money and Austrian economics and some of these things that, while I understand and appreciate, are not what I identify with. What got me really excited was in 2016, I saw Ethereum, and Ethereum showed me how you could use blockchain technology to coordinate people, to build products and do things that they couldn't otherwise have done. Our vision was that crypto or blockchains at their heart are a coordination technology. They are meant to be used to help people coordinate together and align incentives in order to deliver commercially useful products. And that's always what we looked for, is protocols where they're doing something that otherwise would not have been possible. So DeFi is an interesting example of that. Or DePIN is another really interesting example of that. These are creating useful products for the real world. Stablecoins, another useful product for the real world that would not be possible without the accounting ledger, the coordination technology that is a blockchain. So that was our fundamental thesis from the very beginning. And then we looked for different instantiations of that thesis where we could go and apply it. And then we had a number of follow-on criteria for investments because obviously entry price really matters. Obviously, what does value capture look like really matters, right? Like, we're venture capitalists, not venture philanthropists. So we are looking for things that can earn a profit and make a return for us and our investors. So we looked at a number of token economic designs. I think that was one of the areas where we really focused. A lot of people at the time, especially in the early days, were betting on founders. They were betting on people because they're like, oh, this sounds really good. They're betting on ideas. And we did a lot of work on things like the token velocity problem and like how you should design a token and how you should not design a token. What tokens will capture value, what tokens won't capture value, because the economics of protocols are very different than the economics of companies. There is a philosophical misalignment between what the venture crypto community thinks and what the liquid crypto community thinks. The venture crypto community thinks that long lockups signal incentive alignment and that this is a good thing for you to do because it shows that you're around for long term. You're not in it to make a quick buck. You're not going to flip the thing. But the liquid crypto markets think low float, high FDV projects are really hard to invest in because you don't have price discovery when you have a 3% float, right? Like that's the number. You might see a number on the screen, but that number is not actually what the asset is worth. You have a 3% float, and so you have this disconnect. Let's look at, traditional markets. Gold is what percentage of total wealth, right? It's a small minority of total wealth. Actually, most global wealth is in global equities and real estate and other real productive assets. Yes, we do need financial assets in order to make the economy function, but financial assets should always be a minority compared to actual productive assets. And to me, Bitcoin is going to be enormously valuable, is already enormously valuable. I think it's going to be far more valuable than it is today. But to me, that is a financial asset. Bitcoin is not a productive asset. You can't do stuff with it. It doesn't generate cash flows. It doesn't have a business model behind it. It's just an asset. Whereas when I look at something like a Solana or a Helium or some of these other projects in which we're investors, these are productive assets. They are businesses that deliver a product that consumers are willing to pay for.
Despite a 0.6% decline last month, Ethereum remains the leader in the crypto world with 180,000 developer activity events, far surpassing BNB Chain's 99,100 events. This high level of development often signals technological growth, indicating that Ethereum is actively being upgraded and expanded. Additionally, Ethereum is among the most centralized cryptocurrencies, with 44% of its supply held in 10 main wallets. This centralization is seen positively by some, as most of these major holders are staking platforms that contribute to network security while offering rewards, reducing supply pressure, and potentially driving up prices during high demand. However, Ethereum ETFs have recently experienced negative flows, with outflows totaling $1.7 million, suggesting growing investor caution. Ethereum co-founder Vitalik Buterin has reportedly reduced his holdings from 325,000 ETH to 240,000 ETH, worth around $592 million. On a technical level, Ethereum has dipped below a crucial trend line, which could indicate a further drop below the $2,000 to $2,300 price range. Historically, Ethereum has seen significant rallies after similar dips, with key resistance levels between $2,817 and $3,542. A successful move above these levels could spur further growth, though traders are increasingly cautious, as seen by a 5% decline in open interest in the futures market. In conclusion, with these developments in mind, do you prefer investing in Bitcoin for long-term value, or are you considering diversifying into other blockchains like Solana or Ethereum? Share your thoughts in the comments below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.